Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. A lot of great things to talk about. We're going to kick off the show with, this was a surprise, but retail sales are still surprisingly strong. We're going to talk about that, so you're going to understand those. Our quarterly report's necessary for public companies. That came out this past week, and we'll discuss that. Good thing, bad thing, we'll talk about it. And as your financial advisor, quiet retiring. We'll discuss what we mean by that. You might say, what does that mean? We'll tell about it. And if we have time, I hope we do, Chase, understand the risk of low-rated bonds that people start investing into. We'll discuss those. What do we got for companies, Chase?
The company we're going to look at includes Zillow Group. We're also going to look at Workday, Lyft, and Synopsys. So a nice full slate here. And as always, we'll give you a breakdown of what we think of as a buy, sell, or hold based off the numbers that we see here. So as I said, excited to get going here.
All right, well, let's jump into the retail sales are still surprisingly strong because although the labor market has been softening and consumers say they are worried about inflation, people are still spending money. August retail sales, and this was just shocking to me when it came out, they were up 5% compared to last year. And if the annual decline of 0.7% in gasoline stations, you back that out, sales would have increased by 5.5% compared to last August. Where are people getting this money from?
I mean, people are definitely spending money. And I forget, we were talking to a client actually the other day, and he's like, I just kind of used my surface level research, and the economy is pretty strong, right?
Yeah.
And, you kind of cancel out a lot of the noise around the labor market, and people are spending money, and that's still flowing through on these retail sales. And it was broad-based strength. It wasn't like, well, this one thing lifted the retail sales numbers. It was broad-based, and the only other major categories that saw declines were department stores, where sales were down 1%, and then building material and garden equipment and supplies dealers, that actually fell 2.3%. So, that kind of home improvement space, that's still struggling. We've seen a little bit more volatility to the numbers within that space, and some positive months, some negative months, but as a whole, it has still been a challenge sector there. Non-store retailers, people are loving the online shopping, and we didn't think it would continue on at this pace, I think, when we started talking about this a few years ago. But that was up actually 10.1% compared to last year. And this is really where I remain steadfast on the belief that the economy is okay. Food services and drinking places still saw impressive growth of 6.5%. We've said it many times, but I'll say it again. People will not go out to restaurants if they're worried about their paycheck, if they're worried about their finances. That is one of the most discretionary expenses and one of the first places people generally cut in a slowing economy.
And Chase, what worries me here too is that you see the reports, and when they do the surveys for people, oh yeah, I'm concerned, I'm worried, I'm not going to be spending. But when they get to that store, they go out, they spend. So they're saying one thing, how they feel, but when they actually go out, they actually do spend, and that's something important. And because of this report, this worries me that the Fed may have made a mistake and cut rates too quickly. That's a good retail sales, and if they overstep, that people don't realize the risk they run of overheating economy and added pressure on inflation. Inflation can destroy an economy, and that's why we all figured that he would probably cut a quarter, but weren't sure after seeing that retail sales. Maybe he shouldn't. The market probably fell dramatically, but it's just I get a little bit worried about inflation because people are out there spending money and doing well.
Well, the big question is, a quarter point I don't think is going to have a material impact. The question is what happens going forward, and Powell used the term risk management cut when they cut rates. It wasn't the start of a cutting cycle, which some people were kind of hoping that would be the language, but a risk management cut kind of tells me, things are still on the table that, maybe we don't get many more cuts. And the thing that's interesting is right now the numbers have it baked in. If you look at the Fed's dot plot, which is, the Federal Reserve members, both voters and non-voters, there's 19 members. What they think will happen through the remainder of this year, there's only 2 meetings left in October and December. Well, it was voted 10-9, essentially, that there'd be 2 more cuts, while the remaining thought, I think, one, maybe none. I don't know if there were some that thought none, but either way, it's a very tight, race. It's not like, 18 of them think we're going to have two cuts by the end of the year. And then the interesting thing is it gets even crazier when you go into 2026. I mean, some essentially have no cuts. Some have 4 cuts. Some have 3 cuts. I mean, we're all over the board of what's going to happen next year. If you take the median or the middle of Fed rate cuts next year, it's just one cut.
Right.
But again, it's all over the place. That policy is up for discussion.
Well, and I think they really got to look at the data because I don't like predictions because you can't tell what the job report's going to be, the CPI is going to be, the PPI. If those come in as a surprise, that changes the whole thing. So I'm going to reserve and just wait to see what that data is before I see what happens.
They've been so off so many times on the annual basis, which, again, I don't want to throw it out because it gives you an idea of what they're thinking. But, the range next year essentially is you have 2 people that think rates could drop to as low as 2.5 to 2.75%. And you have 2 other people that think rates essentially would be pretty close to unchanged, just one cut. Those 2 people think 3.75 to 4. So as I said, it's all over the place. What's going to happen next year? I don't know. I think we know where President Trump lies. We did see his new Fed appointee, and he worries me a little bit, honestly.
And you know why this is so important? Because the market is at lofty valuations. And if they say, no, inflation's a problem, we're not going to cut, the market's going to tumble because it's way above where it should be. And all it takes is that bad news come in, and that's going to be a problem. That's why we're still cautious. I wouldn't be jumping in like, oh, yeah, everything's great, and they're going to cut because data can change that. So we want to be careful.
And the only thing is I think, we're going to get a new Fed governor next year, and I think you could have a lot of Fed cuts next year because you get a new governor. Mirren, the new guy, said he thinks rates should be around 2.75 to 3% by the end of this year. I mean, if Trump appoints another extreme dove, you're going to really start to tip the scales. And it doesn't mean you're going to have, 5-6 cuts next year. But you probably push pace and maybe get 2-3 cuts next year if they are able to convey that message. Now you got Waller, Bowman, Mirren, and a new Fed governor. So we'll see. But I don't think it's the right thing.
Yeah.
But that doesn't mean that's not what's going to happen if there are more doves on the Fed.
Right. And we got to move on. But it is something that worries me that they're too loosey-goosey to cut rates because President Trump wants that. And that's not the right thing to do. And you got to be more concerned on inflation because that will have a bigger problem longer term.
Potentially inflates the bubble further.
Yeah. Oh, and then you have to have rates rise dramatically. It's just a terrible situation. So hopefully they don't, fall to the pressure. But let's talk about something else that President Trump came up with, and are quarterly reports necessary for public companies? Well, President Trump did come up with the idea of switching company reports from quarterly to semi-annually. It appears Trump believes this will help companies focus more on the long-term business performance rather than fixating on short-term quarterly reports or quarterly numbers. There's also hope that they'll save time and money for public corporations, what they will, because it's expensive to put those reports together. And a quarter, as you know, comes very quickly. So it's expensive, hard to do, and it's something that could make some sense. And for long-term investors, well, I think there's some possibility thought there.
Yeah, this isn't just kind of Trump saying it at this point. Now, the SEC has actually acknowledged that they are actively looking into the plan. As a spokesperson for the agency stated, at President Trump's request, Chairman Paul Atkins and the SEC is prioritizing this proposal to further eliminate unnecessary regulatory burdens on companies. And we did actually hear from SEC Chair Atkins here, just saying that he has talked to the president about it. And in principle, he thinks to propose change in what our rules are now, I think would be a good way forward. And then we'll consider that and move forward after that. And he did say, essentially, it would be left to the companies to decide whether they switch to semi-annual or stay with quarterly.
Yeah, I'm wondering, I don't know how many companies would stay with quarterly. That would be kind of strange.
You get this in Europe right now.
Europe is every 6 months.
Europe's every 6 months, but some companies still release quarterly numbers, quarterly profits, things like that. They don't do
maybe
a
if you're a
full
newer
fledged
company and you want to get that data out, maybe.
I don't know. Some of the big companies do as well,
Yeah.
but it's not as tedious because it's not like a full release. It's like, oh, this was our profit for the quarter.
Yeah. No guidance, just numbers. Well, being a long-term investor, we can see the benefits of changing this requirement, as one quarter should not dictate your decision on whether you should buy, sell, or hold any business, any stock, any equity. Ultimately, a change like this wouldn't have a real impact on my investment philosophy. And if this enables companies to focus more on the long term, help with cost, I would be in favor of giving companies the option to make this switch. I mean, it makes sense because we've had companies in our portfolio, some of them for 10, I think maybe even 15 years. We do read the quarterly reports to make sure what's going on, but if they didn't have guidance on the quarterly report, we're not going to make a difference for us. It's based on what we look at the value of that business is.
Yeah, I mean, if you look at a 6-month period, I mean, basically when you look at a cash flow statement, an income statement, you're looking at a period of time. So now instead of looking at 3 months, you're looking at 6 months. If you're looking at a balance sheet, that's just a snapshot of where they're at in that point in time. By going from 3 months to 6 months, it's not like you're losing data. You're just losing the frequency of data.
Right.
The data still remains the same.
Right.
It's just you're not getting it every quarter, which, as you said, shouldn't necessarily be a reason to buy or sell an equity. If you get like one bad quarterly report, we're generally not going to sell that business.
No.
We want to understand what's going on. But I mean, kind of speaking to that point, I mean, looking at the long-term focus, both Jamie Dimon and Warren Buffett have spoken out against not necessarily the quarterly reports, but the quarterly guidance. And in a 2018 op-ed piece for the Wall Street Journal, the pair said, in our experience, quarterly earnings guidance often leads to an unhealthy focus on short-term profits, very important here, at the expense of long-term strategy, growth, and sustainability. So, I mean, this is something that we look at being long-term investors. Again, quarter to quarter is not as important to us of what's going to happen in the next 2, 3, 4, 5 years.
And this could help some companies, that say, gee, we don't want to come public. We want to be private. I mean, a lot of private equity now. Maybe this will help with that because as to the regulatory burden, I'm sure there is hope that this would help entice companies to come public. There has been a huge shift in companies staying private longer. And I do believe the compliance piece deters some from coming public. There's just a lot to do public. I've heard CEOs say, it's a lot to do, so we're going to stay private for a little bit longer. I'm sure there's other reasons for staying private, including control and other liquidity avenues that weren't as prominent years ago. Nonetheless, it is concerning that the number of publicly listed companies, and I didn't know this, when I saw this, like, wow, number of public listed companies in the U.S. has fallen from more than 7,000 back in 1996 to only around 4,000 today. That's almost a 50% drop in companies being public, and it's too much of a burden. And I like the publicness because you got to disclose everything. I worry a lot about private companies, private equity, because I don't think they're disclosing what they should be disclosing.
Yeah, and I mean, kind of talking about the other avenues. I mean, I think I saw on Friday, I think XAI, Elon's AI company, I think he got like a $10 billion raise and gave the company like a $200 billion valuation or something like that. I mean, that used to not happen where you would do these private raises and raise $10 billion.
Right.
I mean, that is, again, I think one of the big reasons why companies are able to stay private, because if you need liquidity, well, you needed to go public to raise funds and do that. But now you can get $10 billion in the private market. Why go public?
Yeah, and when I think about it too, that there's just things being private that worries me, and I like being public. You can see through, but maybe it's not needed every quarter.
I mean, I'll look at us as a very small microcosm of it. We are a private business. Would I want to answer to shareholders and answer to the SEC and all these filings and do it? I mean, if you look at like the SEC filings on a public company's website, it's like, oh my gosh, the number of filings that they have to do is just crazy. I mean, I'm not saying that all filings are bad because it needs to be there so you can get good information. But I think sometimes it's just obviously overkill.
And also, too, I think for short-term traders, they don't care. They don't look at it anyways.
No, they don't look at it anyways. But I was going to say, too, to the quarterly reports, and we've talked about this a lot before, where, one reason this might be beneficial is a lot of times companies will just try and massage earnings a little bit to try and hit that quarterly number, where if you do it every 6 months, I think it gets harder to massage those quarterly numbers. And that's where, again, that long-term focus, I think, could weigh out. And we'll see what happens. I mean, this is not going to change tomorrow, but, maybe 6 months from now, we'll be talking about a different situation.
Said, wouldn't bother me. I'd be fine with it. So
no material change to our business.
Nope, exactly. Is your financial advisor quiet quitting? Well, quiet retiring, because you may not completely understand what quiet retiring means. But a few years ago, Chase and I were on the Dr. Phil show because they're doing an episode on what they called quiet quitting. And that's, and Chase and I were on the pro side for business and working hard, while the other side essentially felt that they should get paid the same amount and not do much work at all. They would show up physically, but mentally they weren't really there, and they called it kind of quiet quitting. So I kind of coined the phrase, quiet retiring. because I'm seeing that happening and I hate to say it, I love our industry, but I'm seeing it happening with people I know in the industry.
I don't love our industry.
Well,
There's a lot of bad people in our
Okay.
industry.
I love what we do. I love the concept.
I
of
love
it.
our business.
Right, there we go.
I love the way we take care of our clients, but gosh, there's a lot. I mean, we just met with a potential client this past week, and she was sold all of these annuities with these high income riders, just awful. And this industry perpetuates a lot of great salespeople. So I don't think I love the industry.
Yeah, thank you for correcting me on that. I love the concept, I guess, of what we can do.
There we go. And, kind of talking to this point of quiet retiring, I mean, we've been seeing this in the financial service industry, especially considering the fact that the average U.S. financial advisor is 56 years old. I've noticed that more of them feel that they deserve to play more golf, which neither you or I golf.
No.
Gosh, big time commitment, and it's so hard and frustrating. Or they like to, of course, travel around the world. And it seems like doing more than that than the average person, since they almost seem to be in retirement mode. It's like, the book's kind of doing his thing, and I'm gonna go to Europe for a month.
Yeah, I won't be missed, which is kind of amazing. And they're not telling their clients this either. And they have their admin staff handle most of the routine details. So you, the client, really don't know that they are not working that much behind the scenes. Hence the term quiet retiring. You don't really know they're retired, but they virtually are. Something you definitely should find out is how much your financial advisor is working. What are they doing behind the scenes? Or are they even at the office? Especially if they're in their mid to late 50s, because you may not have the person with the most experience watching your investments. And that's what really worries me. You might think, well, this guy's been doing it for 40 years. But he's not handling it. His assistant, who's been doing it for 10 years, is the one that's doing most of the work.
Yeah, and I think this is really important right now, because when things are going up, I don't want to say that you don't really care, but you don't really notice, because everything is going up. Like everything has been going up the last 10 years. I mean, not to make money in the last 10 years, you had to do something pretty bad.
Unfortunately, we've seen some people that had unfortunate advisors that are pretty bad.
But this becomes so important in preparing for and weathering through difficult times. You want to make sure that person with the experience and the knowledge is able to guide you through those difficult periods. So if your financial advisor is talking about retiring in the near future, be sure to understand fully what the succession plan is and who you will be dealing with. It has now been known in the industry for a few years that the average age of financial advisors, as we said, is getting older, again around 56 years old, and less younger advisors are coming in the industry. So you have to be sure that you understand who your financial advisor really is. Is it really the advisor, or the person that maybe is only 25 years old working on the admin work behind the scenes, handling all the details? And who is watching your portfolio? And is your investment advisor one that is quite retiring?
Right. And I did see studies of younger people. The reason they don't want to come in is like, I don't want to sell. And I said, I've never sold. I've always presented what we do. I think we've come up with a great concept. We now manage $750 million. We've done that because we do a very good job for our clients, and we don't sell. You come in for the presentation, we show you what you do. If you like it, great. We'll do the paperwork and think about whatever. But we never I remember all the sales techniques when I first got into it. Well, do the Ben Franklin close. Ask them what they don't like, what they do like. And then what can I say that all these sales techniques, that would bug me too. And that's unfortunately a lot of salespeople in the industry, which why, as you said, we don't really like the industry. We like the concept of the industry. But it is very important to make sure that you know who you're working with, because there are some people out there that just aren't doing the job they should be doing, and you might think they have the experience, but they're not in the office working.
Yeah.
So we got time to do the understanding the risk of low-rated bonds, I believe, right?
We do.
Let's jump into that. So some investors are, rightly so, have started selling stocks, and they're not excited about buying more stocks at this time. Unfortunately, though, it seems investors got used to the high returns. They have turned to low-rated, high-yield bonds. According to J.P. Morgan Chase, issuance of junk-rated bonds and loans hit a monthly record of $240 billion in July. In 2025, $930 billion has been raised through junk bonds and loans, and that to over the one. And add to that, I want to add to that over $1 trillion in junk bonds from 2024. There's a major growth in high-yield junk bonds, and that's not a good thing. I did go through the 1990 high-yield crisis, and it was terrible for people.
Yeah, and when you look at it, a lot of people think they're maybe not taking on that risk because they're not buying individual junk bonds in many cases, but they have been plowing the money into high yield mutual funds and exchange traded funds, again, also known as ETFs. If you dig a little bit deeper, you find some companies are raising money foolishly, like this company called TransDime Group. I've never heard of them, but I guess they did a huge issuance of nearly $5 billion in a high yield bond in August to pay a dividend to their shareholders. We like companies that pay dividends, but it should be from cash flow, not from borrowing money that then has to be paid back. That could really jeopardize the balance sheet. Yeah, you get a nice dividend, but all of a sudden it's like the company goes bankrupt and now you lost your principal.
Yeah,
that makes sense.
We had to borrow money to pay that dividend. Just raise the debt is what we did. That's terrible. But the other thing I don't like is business development companies are also back in the news again. I don't like these guys. And these businesses have private loans to small and mid-sized companies. Over the 12-month period ending in June, private loan activity increased by 33%. I have similar concerns with business development companies and private credit, which I believe will have a crash sometime in the future and cost investors more money than anticipate. And some people I don't think even know that they're in these business development companies or private equity.
Oh, I'm sure not. I mean, most of the time people just look at yield and they're like, oh, it's just like a bond. There's a lot more to it. Again, if the risk-free rate is 4% and you're getting 10%,
think about it.
There's risk, to say the least. And one thing that we look at is the current default rate on high yield bonds is 4.7%, which is not bad, but it's not good either. If interest rates on the long end were to increase, which I do think is still a good possibility considering the need for government debt continues to increase, well, that could, again, cause interest rates to increase. This could then slow the economy and cause some of these smaller companies that have these high yield loans to default and file bankruptcy, which means investors would lose money. And you have to think about it this way, even if you're in an ETF or a mutual fund, right? If you're getting this, I'm going to make it easy on me, a nice 10% yield, but 5% of the companies go bankrupt, well, now you've lost 5% of the principal in there. So you're not really getting a 10% yield because you've wiped out 5% of the principal.
Right.
That is where things can get very dangerous, and everything is fine until it's not.
Yeah.
And that's where, again, I think a lot of people are maybe naive to this fact that, oh, I'm safe. I'm in bonds. I'm getting this huge yield. You got to be careful in these because you could get blindsided when you least expect it.
Yeah, all this information does come from our newsletter, Smart Investing newsletter. Goes out every Friday at 5 o'clock. It is free. Sign up. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Sign up for the newsletter. A lot of great information there. I do want, time is just going by too quick as it always does. I do want to jump into our company before we run out of time here, and that is Zillow. I mean, real estate is what they do. Love their symbol, Z, as in Zillow. Now, they're not in real estate. It says internet content and information industry. So I guess while they deal with real estate, they're in the internet content and information industry. 6.4% short on the float. 96% institutional owned, no PE ratio. I don't like seeing that. That means they have no earnings over the last 12 months. We do see price to sales 8.6, about the same as the industry at 8.3. Price to book value 4.4 versus 7.1. Price to cash flow is very expensive, 42.7 versus 22. And no PEG ratio for Zillow, unfortunately. Now, they have no earnings over the last year or the last 5 years. Their sales did climb, however, by 15.3%, which is slightly better than the industry growth at 15%. The analysts give it a terrible 5-year earnings per share growth estimate of a negative 149.9%. The industry gets 15.3%. They do not pay a dividend. Look at the balance sheet. Current ratio, very good, 3.3 versus 2.1. And also, debt to equity is only 0.1. They don't have much debt, so they can go on through difficult times. Surprise on this, intangible assets, 63.6% of their assets. That's pretty risky because if those get written down, that could really hurt the company there. We do see a net profit margin. They lose about 2.6 cents in every dollar they bring in. The industry makes 30.2, so a big difference there. Return on equity, a negative 1.3. We do see free cash flow is only $215 million. I say only because the industry is at $48.7 billion. So I'm not saying anything that's exciting me too much on this, and I thought maybe this would be a time to buy this. It was to pull back a little bit, but maybe you got something good going forward.
Yeah, I mean, the reason it was kind of intriguing was Bernstein actually upgraded to an outperform this past week and said it has been warming up to its fundamental story inside the company's recent execution on revenue growth as a factor. And one thing is, real estate kind of slowed quite dramatically over the last couple of years. Could we be in an inflection point where real estate starts to pick up, and maybe that's where that revenue story continues to get better for Zillow? But looking at the current price for the company, again, their ticker symbol is Z, $86.74, 52-week range. Wow, the low $57 and the high $93.88. So much closer to the high over the low. Year to date, it is up about 17%. Looks like over the last year, up about 32%. Last 5 years, though, yep, this was one of those hype companies. It looks like back in 2021, it was trading, looks like near $200 a share. So definitely kind of petered out from the excitement back then. But going forward for Zillow, again, we go out to, let's see, they do report on a calendar year. We go out to December 2026. I see estimated earnings per share of $2.22. Fortunately, still gives a target sell price of just $36.85. So it's still expensive on a valuation perspective. And, you and I were kind of talking about Zillow beforehand. I'm like, this is one of the companies I want to like because I think there is room for growth in that technology of real estate.
I think there is too, and I like how because when I want to look at something, immediately I go to Zillow. Yeah. They've got that catchy name. They've got the eyeballs going there. And I know what they do is that they do sell, I think, the leads to real estate salespeople and stuff. It's just a great concept, and I'm disappointed it's not doing quite as well. And this could be a growth company that we may never get because we like to get things on sale. Growth company, we talked about things like the gambling companies, online gambling. We felt they would do well, but they were never a value. Could be the same thing with Zillow. I'm not sure what it would take to have a pullback for us to buy it or earnings go up, but I think it's a great concept. It's just not a value that gives us the safety we want to be with.
Yeah, I mean, the thing that I guess intrigues me about it, right, is I think they were the ones that kind of talked about this like super app where, it's all your real estate in one app where I think they are, it looks like on the summary, they do have something around mortgages as well. So it's not just the sale and leasing of properties, it's also around the financing of properties. And then as you said, I mean, there's got to be other ways they can make money because, just your average person that, is curious when a house goes up for sale in the neighborhood, most people go to Zillow. It's like, I'm sure that they probably make money or could make money from advertising on that platform too. I think there's a lot of avenues here for growth, and that's not the concern. It looks like sales and earnings are anticipated to grow. The reason yours was so negative, I think, was because it's coming off negative earnings. Yeah. But that growth is there. It's just how much are you willing to pay for it? And as value investors, that is something we don't like to get involved in.
No, exactly. So there's the skinny on Zillow. So I'm going to take a quick break here. When I come back, we're going to cover Workday, Lyft, and Synopsys. So stay with us. You're listening to Smart Investing Show with Brent and Chase. We'll be right back. Alrighty, welcome back to Smart Investing Show. Yes, this is where we change over and we talk to our financial planner, Harrison Johnson, who's a CFP. And Harrison, you told me quickly before the break you're dealing with underwater cars. I mean, what do cars in the ocean have to do with?
Well, the water levels are rising. Ocean levels are rising, so more and more cars are getting underwater now. So Chase and I were talking about this earlier in the week. There was an article on CNBC that says that right now, 26.6% of trade-ins have negative equity on average.
26%. Wow, that's
26. So yeah, about a quarter. About a quarter of trade-ins, when getting a new car, have negative equity on that, and the average negative equity is about $6,500. Which
wow, that's a lot.
It's a lot, but I mean, when you think about, cars are depreciating assets. So you buy a car, it instantly starts to depreciate, and the trade-in value of a car is the lowest value that you can get for it. Dealerships have their own price. If you sell it to a private party, that's a different price. If you trade it in, that's the lowest price of the three. So as soon as you buy a car, if you buy a new car, finance it, don't put a lot down, it's very possible that you're not going to have equity. So on financed cars on the road today, about 40% of them have negative equity.
Underwater,
yes.
Now, do you have the key on how to fix this for people? Because
well, there's two sides of it, because on the one side, I think if you can afford a car, which that's kind of a ambiguous thing, right. It's relative based on the situation. I think the definition of being able to afford something is as long as you can survive and pay your bills, and then also save money and invest money to cover your future goals like retirement. Any additional income that you have is more or less discretionary. So if you want to use that to buy a car or whatever, fine. And if you are going to buy a car or any type of asset, you want to buy it at the lowest cost, which if you have the ability to finance something at a really low rate, that's might be cheaper than paying cash, even if that results in potentially having negative equity. However, I think in most cases when people are buying cars, driving for a couple of years and then trading them in after a couple of years, they have negative equity and then they're rolling that into the new loan. That's probably not a good situation in most cases. Right. So, but I mean, cars should last a while. I mean, my car is like 12 years old right now.
You are the exception.
Yeah.
I think you'll get every mile out of that car. So.
My car is now,
yeah.
Gosh, what, 7 years old.
Yeah. I mean, I do keep my cars a long time. I just keep buying new ones on top. So now I have like 7 cars.
Well, and again, that comes back to, you can afford it. So
right.
It's, it comes back, assuming you can afford it, you want to buy it at the best way possible, down payment, financing and everything. But with the fact that so many people are underwater, if you're buying a car and then trading it in after a couple years with trade-in value again is the lowest, and then you just keep financing this, usually depending on the loan to value ratio of that new car, you might not get as attractive interest rates. You might also have to get gap insurance and things like that. So it's an expensive way to buy a car.
Do you think it's people, because at that point, right, if you're continuously trading in these cars and racking up these underwater, essentially, values, shouldn't you just lease a car at that rate instead? Because then you just turn it in after 3 years and you don't have the fact that you now have $6,000 of negative equity in a car.
Potentially, yeah. Long term, I think a cheaper way to have a car is to buy a car than have it for a very long time. But that's assuming that you keep that car for a long time. But if you're going to be, buying new cars all the time and trading cars in after 2 to 3 years, then yeah, leasing might make sense. Because when you have a loan, an amortized loan on a mortgage or a car or anything like that, the first couple years are mostly interest anyway. So your principal balance on the loan isn't really decreasing that much, but that's when your car depreciates the most in value. So, the negative equity that you have is greatest in the first couple years of having a loan. So, the best thing to do is not be trading in a car and maybe not be buying a car if you don't have enough equity or you don't have, extra cash that you can put toward it.
And one thing I hate on car salesmen is you walk in, what's your budget? What can you afford?
What's your monthly payment?
What's your monthly
It's kind
payment?
of how life insurance is sold too, actually.
Actually, it is. It's like, I said, but it's the overall cost of everything. But they don't care. They want to get you in that car, and they don't care what happens after you leave that. What can you afford? What's your budget? Like, no, don't tell me
Doesn't
that.
matter. Yeah.
Right?
Oh, 84 months then. Yeah, we'll just stretch it out. We'll keep that monthly budget low.
Right.
You put down more money on the front side of it, and that'll lower the monthly payment too.
Yeah.
Are these things you kind of work with people to try to help them understand about?
So, I mean, buying a car is a large purchase.
Right.
So, buying a house is a larger purchase, but people buy cars fairly often. And it's something that I look at because people look at, well, I'm going to be selling this car or keeping this car and buying another one. How should I finance it? How much should I put down? Which loan terms make the most sense? So this is definitely something that I look at. However, I will say most of the people I work with don't have negative equity in cars. Most of them, want to pay cash. And I'm like, well, we can get 0% financing. Let's take advantage of that.
Yeah.
So, buying cars and the best way to do that, since it's a large transaction, there's better and worse ways to do it, and I deal with it. But again, I think it's interesting that, a quarter of trade-ins have negative equity, and that's just perpetuating the problem for a lot of these people.
Yeah, just people not doing the right thing. And I think people spend more time shopping the car. They should spend more time shopping for the financing and put down less and get much better financing. You said, why pay cash when you get 0% financing?
Mm-hmm.
I mean, so shop for the financing.
But the problem is it's not going to get rid of the negative equity problem. But the negative equity problem, in my view, is not the problem, right? It's just people aren't financing it or buying it the right way. I mean, my Suburban, very large negative equity because I got 0% financing, so I put nothing down on it. It's
that's the thing.
But you plan on having like 5 kids, so you plan on having the car for you might be like Harrison, have it for 12 years.
Yeah, I mean, that's what I mean is the negative equity isn't the problem. The problem is that people have this negative equity and then they turn it back in at a bad price. And it's like, well, you should have just maybe leased, that would have been a better thing. But I think people think they're making the smart financial move by buying a used car potentially, and it's like, well, maybe not.
I don't know if they're trying to make a smart financial decision. I think they want a car, and they're doing it just to get that car. I mean, you can trade in a car and then roll that equity, negative equity, into a new loan. You can do it. You can also carry interest on a credit card. It doesn't mean you should. Yeah. So,
and I think you said none of your clients actually have negative equity in the car, or in that.
They might have negative equity, but I've never seen any of my clients trade in a vehicle that has negative equity. Yeah.
And I was going to say that's because they come to you because you're smart as a financial planner, and they're smart going to a financial planner, really understand their finances better than just saying, oh, yeah, my budget is this. Okay, I'll just buy this car. Getting too much car, more than they need, roll it over. I mean, all these crazy things people do.
Yeah, and I mean, when you think about it, car payments can be $500, $800, $1,000 a month for, a normal-ish car.
Right.
That's a lot of money that you can be applying toward a retirement account. So if you got 2 car loans, you're making payments. Yeah, it's tough to get ahead, and that's kind of back to the question of, can you actually afford this? If you can't afford it, if you're not saving for retirement, having the discretion to buy a nicer car all the time is more of a luxury. Prioritize, the things that actually matter.
I had a client ask me, he goes, I did this. I put a lot down, and I got this high loan. Did I do the right thing? No. You should have asked me before you did it.
Well, that's another thing, too. Yeah, people do things. They're like, yeah, I did this. It's like, well, we could have done this. But a lot of times it's just little tweaks, but they make a big difference.
If you're a financial planning client, they call you, they can ask that question before they buy the car.
Hopefully they do. I tell them. I mean, some people are like, well, I don't want to bother you. No, please bother me. That's what I'm here. Before you do something, let me know about it, and maybe I'll say, yeah, continue to do it that way, or let's do it this way instead.
If they call you, maybe they won't be rolling over negative equity when they get a new car.
Hopefully not.
Hopefully not. Great information.
All right. Thanks,
Harrison. All right. Again, that's Harrison Johnson. He's our financial planner at Wilsey Asset Management. If you want to contact him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. You can send him an email. Go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Chase, you ready for another company?
Let's do it.
Are we doing Workday?
Workday.
Workday. All right, let's do Workday. Their symbol is WDAY, Software Application Industry. About 5% short on the float. Nothing to be concerned with there. PE ratio 108.7 versus 52.2 for the industry, so a high PE industry. Price to sales 7 versus 6.8. Price to book value 6.8 versus 7.1. Price to cash flow is 24.3. That is better than the industry at 31.7. They got a good PE ratio, 1 versus 8.3. So that's the only positive I've seen so far. Now, I don't know what happened here, but over the last year, their earnings fell by 63%. The industry was up 5.5%. The sales last year were up 13.9%. Industry was only up 4.7%. And the 5-year earnings per share growth estimate for the analyst is 26.4% for the company versus 8.2% for the industry. So that's a positive there. Workday does not pay a dividend. Look at the balance sheet. Current ratio is strong, 2.1 versus 1.7. Debt to equity, 0.4 versus 0.5, so no problem with the debt there. Net profit margin is 6.5%. That is half the industry at 12.6. We do see return on equity is 6.4 versus 19. Free cash flow does look pretty good, $2.3 billion versus about $2.8 billion for the industry. Not too many things I like in this company, a couple of good things, but maybe got some good growth going forward.
I was kind of looking at the company, and they are in the enterprise cloud applications business is what they do. It looks like they offer a suite of financial management applications, looks like some maybe HR tools, kind of cost management, things of that nature, again, in the cloud. So that was kind of the hype several years ago. But I thought this was interesting. I didn't know this. I have heard the name Workday before, but the company was formerly known as North Tahoe Power Tools, Inc.
What?
This was Seeking Office telling me, so I'm going to go with it. But I was like, what? And I guess they changed its name to Workday in 2005. So this company has been around for several days or several years. And I think they're the ones that, like, they have the Rockstar commercials on TV.
Oh, where Billy Idol and
and
Kiss, I think those guys.
Yeah.
Crazy commercials.
Play like the air guitar, and I think they're funny. I mean, gosh, the first time I saw one of those commercials, I was cracking up. So kudos to their marketing department. I don't think we could use Workday,
No.
Great marketing. But looking at the business here for Workday, current price, again, their ticker symbol WDAY, WDAY, essentially $233.62. 52-week range, the low here is $205.33 and the high $294. Kind of, again, talking about the hype of, the cloud. And
Right.
Are we going to see the same thing with AI? I think so. But if you look at the 10-year return for Workday, it's like 221%.
That's pretty good.
But the 5-year return is just 15%.
Oh.
So all of that essentially came in the first 5 years of the 10-year period. And I think this is what's going to happen with a lot of these AI companies, 10 years from now essentially or 5 years from now, a lot of that return is going to come from the first 5 years, and then it's going to kind of peter out.
Chase, I'm so glad you bring that up because people, they've got to really understand numbers. Because as you say, 10-year return's been great, but it's been terrible for the 5-year. And if you're just buying stuff based on the 10-year return thing, this is going to be a great investment, you could be missing the boat and have terrible returns the next 5 years.
Yeah, you missed your shot, essentially.
Yeah.
So, but yeah, I think that happened. A lot of the cloud companies, a lot of these software companies, that was all the rage. And then, AI kind of took over. But we'll have to see if that shift does occur yet again with AI in the next cycle. But with Workday, the thing that kind of prompted this was the management firm Elliott, the activist firm Elliott. We talked about them, I think, last week about PepsiCo. Gosh, they must have had a ton of cash.
Where do they get these billions of dollars that they have?
They took a $2 billion stake in Workday just recently, and you're like, didn't they just take a $5 billion stake or something like that? And PepsiCo, I don't remember the exact number from last week, but I'm like, wow. And I guess Elliott, what they said is they're pleased with the dialogue with the team and believe the plan announced at the Financial Analyst Day represents a significant enhancement of Workday's operating model and capital allocation framework. We believe this multi-year plan will drive substantial long-term value creation for Workday shareholders, and we look forward to continued collaboration with the company. The thing that I find interesting with this is I thought a lot of times Elliott was more of an activist.
Right.
Are they kind of more being passive with Workday? Yeah, we like how they're doing things. I thought that was kind of strange.
It does kind of sound that way, and I thought they would put people on the board and do ideas. And didn't they also try with Southwest Airlines and they backed out? Was it Elliott that did that?
I don't remember if it was Elliott or a different activist firm.
Okay, yeah. But I mean, activist means you're going to do some activity, not just sit there and buy the stock. But yeah, maybe they're sitting on a lot of cash. I know that's been a problem for a lot of investment companies, sitting on a lot of cash, and we are as well. But we're not quite ready to start employing some of that. But I think we maybe next month will start doing something. But I do see for Workday that the earnings are up about 3%, the estimate over the last 9 days. So it appears to be looking better.
Yeah, I mean, this business is growing. Again, that's not the problem with a lot of these companies, but the overvaluation that occurred was the issue. I mean, because if you go out to January 2027, the estimated earnings per share that I have is $10.49. Gives us a target sell price of $174.13. I mean, that's still a multiple of 22 times. And I'm not advocating for investing in this company, but you're getting earnings growth this year of 22%, next year about 18%. I mean, you are getting substantial earnings growth, so you can warrant a valuation above our target of, I'm going to say 16, 17 times. It's not how I do things, but I can almost kind of see the case of why you'd want to invest in Workday. The PEG ratio looks decent, but it's again just something that doesn't fit our value investing philosophy.
And people say, gee, they miss some companies doing that. But the reason why we don't like growth companies is that the decline can be very high when it comes. I mean, you can have a decline in the stock of 30, 40, maybe 50% very easily. If you have a more low valuation company, that decline will probably not be 50%. Could be only be 10, maybe 20%. So it's a little bit easier to handle that. When you lose 40% on a company, you're probably going to panic and sell out.
Well, I mean, the reason it can be a problem, right, is you're paying, again, I'm going to say, 22, 23 times for the future earnings, but you're looking for about 20% earnings growth. It just takes one little problem for that earnings growth no longer to be 20%. So now that earnings growth falls to maybe 5%. You're like, yeah, well, the company's still growing. It's like, well, now that forward PE went from, maybe 23 up all the way to 30. Well, I don't want to pay 30 times for a company that's growing earnings at 5%. When you buy growth investments, that's the big problem. If they miss on earnings growth, that's where that stock can falter, and that's why I don't like to take that risk.
Yeah, and I saw the other day, too, and we talked, I think, last month about how the margin debt is now $1 trillion. Mm-hmm. I saw it now reached $1.1 trillion. So it keeps going up and up, and it's just something that worries me because if you margin this company and it dropped 20%, you might say, well, I'm just going to sell and get out, and that starts the avalanche downward. So let's move on to Lyft. You want to talk about Lyft?
Let's talk about Lyft.
Okay, Lyft, and we're talking about the car ride-sharing company. They're in the software application industry as well, so not a car company, but software application. The short float on this is pretty dangerous, 16.2%. That's pretty high. We don't like seeing above 10. Institutional ownership is 95. PE ratio is 97.9 versus 52 for the industry. Price to sales 1.6 versus 6.8. That's a positive. Price to book value is 12.8 versus 7.1. That's not good. And then the price of cash flow is 9.1 versus 31.7. That is a positive, and no PEG ratio there. Now, there's no earnings growth over the last year, but sales are up 19.9%, better than the industry growth of 4.7. 5-year earnings per share estimate from the analyst is not very good. It's a negative 54.2 versus a positive 8.2 for the industry. Lyft does not pay a dividend. We do see at the balance sheet here, we've got a current ratio of 0.7 versus 1.7. I don't want to say it worries me, but I don't like seeing 0.7. I like to see it around 1. Which means you can cover the next 12 months of liabilities with 12 months of assets. Debt to equity looks okay, 1.1 versus 0.5. We do see a net profit margin here of 1.5%. Glad to see they have a profit margin. I didn't think they even did. 12.6 for the industry. Return on equity is 12.6 as well. Let's see, free cash flow, $993 million versus $2.8 billion for the industry. I want to like this because of the concept going on, but maybe you got something better to tell me going forward.
Yeah, I'll give the numbers first, and then there's kind of a story that gave it a little bit of a lift this past week.
Lift to lift. Okay.
Yeah, the current price for Lyft, their ticker symbol again, LYFT, $22.58, 52-week range. I mean, it's done very well off the low here of $9.66, the high $23.50. The 1-year return on this is a positive 78%, but gosh, the 5-year return, not looking so good. 5-year return down 22%. And I was like, I'm kind of curious, what was the all-time high for Lyft? It looks like Lyft reached an all-time high stock price of $78.29. Here's the interesting thing. That was on March 29th, 2019. Any guess when they IPO'd?
March 18th?
March 29th, 2019.
Wait, so when did it hit the high?
Their all-time closing high was the same as their IPO date. So they have not closed at an all-time high
since their
IPO date.
Wow. That's the problem with buying IPOs.
Yeah. Yeah, I mean, that's an extreme. I don't know if I've seen that before.
And I know we talked about last week. We talked about StubHub. You said that they're down like 10% from when we talked about it last week, I think.
Yeah, and well, actually, this is kind of StubHub actually went down every single day during after the IPO as well. But the funny thing with Lyft is the IPO price was $72, with trading beginning the next day at $87.24. So that means the first person that bought. They've never made money.
Right.
So it's kind of an interesting story. And again, another example of why you don't get sucked into the hype. Because, this is like Uber. This is going to be great. And it's just like, this is definitely struggled to say the least. But going forward for Lyft, we go out to December 2026. I see estimated earnings per share here of $1.40. I mean, it gives us a target sell price of $23.24, right around the current level. So my forward PE is right around 15.6, 15.7 times those future earnings.
What was your earnings for 2026?
$1.40.
Okay, now I have 32 analysts, and they're showing, I'm making sure I got the number right here, next year, December 26, only 48 cents.
Oh, wow. I only have 19 analysts, so that's...
Okay, and I have one that gives it a estimate of $1.09, but somebody says going to lose 2 cents.
Oh, wow. My range is 96 cents to 2.05, so I don't have any loss, but interesting. But big news, the reason Lyft was
let's talk about that.
Prominent was, I guess, Alphabet-owned self-driving car Waymo partnered with Uber to get its robotaxis in Atlanta and Austin, Texas, but is now teaming up with Lyft for the first time to enter the Nashville market next year. So riders in Nashville will be able to either hail a Waymo via the Waymo One app or the Lyft app.
And I thought that was going to happen because you got the self-driving cars, and then you've got Uber and Lyft that have the software that has all this information that actually you can use. It's just a natural marriage to have that, and that's what I think Waymo and Lyft want to do is kind of marriage it together, use Lyft software and use Waymo to do the self-driving cars.
You know, the CEO of Lyft was on CNBC this past week, and he was talking about how complicated it is to build out a ride-sharing app, and I can kind of understand the complexities of it to a very surface level because I'm not a tech guy.
Right.
But the thing that I don't understand is if Waymo nails this, self-driving car, I still am having a hard time seeing why do they need Uber and Lyft. You have Google Maps.
Right.
You have people that are cream of the crop when it comes to technology. I just don't see why they wouldn't be able to build out their own app. And they have already started that. Now they're going to, I guess, kind of compare costs. They're partnering with Uber, partnering with Lyft, and they have their own Waymo One app. I don't know if partnerships 5-10 years from now would be as profitable as having your own app. And, I'm not in the day-to-day business of it, but to me, I'm like, I think there's a lot of risk to Lyft if things don't go the right way.
Yeah, and I think they would actually merge would be a better thing eventually because and I think it'd be very costly to do that app that Uber and Lyft have because I think they've probably spent a lot of money on it, I'll say. And there's things that they have where you probably wouldn't think of, and you can't just steal the app. Yeah, so there's probably some value to there, but I agree with you. I mean, eventually that's going to go away. So either Lyft has to buy Waymo, or Lyft is going to be bought by Waymo or somebody or Google.
Or there's still the chance. I know it'd be difficult, but I still think Waymo could do it. I mean, because part of the problem with the Lyft and Uber is I think pairing up your driver with a person. Well, if you get rid of the driver, now you just have one side of the equation. But again, I don't know the technology that's required for that. So that would require a lot of research to understand how much risk is there to Lyft and Uber long term.
Right.
I know Tesla, they're talking about doing their own thing. So
yeah, that could be. Well, let's move on. We're running out of time here, so let's move on to Synopsys, which symbol is SNPS in the software infrastructure. We know a lot of software companies today, it looks like. Only 1.8% shares short there, so that's good. They do have a PE ratio of 67 versus 51.6. Price of sales, 12.1 versus 7.8. Price to book value does look good, 3.3 versus 11.4. And price of cash flow, well, that checks in at 54.3 versus 31.6. Now, the earnings for last year on Synopsys, they fell by 23.7%. The industry was up 0.6. Sales declined by 0.7% for Synopsys, but the industry was up 1.6. 5-year growth rate on the earnings for them is a negative 153, not very good. Synopsys does not pay a dividend. Let's take a look at the balance sheet here. Current ratio 1.6 versus 2, that's okay. Debt to equity 0.6 versus 0.9, that's good as well. We see a net profit margin that's very good, 31%, double the industry at 14.8. Return on equity is 7.2 versus 29.8. Free cash flow, not very good. It's $1.3 billion for Synopsys, but the industry shows about $41 billion. So not liking what I got here. And I think we looked at this company and said, let's do it because it fell a lot recently. Stock price did.
Yeah. I mean, the stock, gosh, it fell, I guess, 35% after they reported a disappointing fiscal third quarter results. I was kind of surprised by this. The company actually earned $3.39 per share on revenue of $1.74 billion. I say I'm surprised because the estimates were for $3.74, so $3.74 to $3.39, and revenue was estimated to be $1.77 billion. So it wasn't a huge miss to warrant a 35% decline. I mean, that's huge when you look at it.
Yeah, that's a lot. And I think you said the earnings estimate.
I haven't given the earnings estimates
you haven't? Okay.
yet. So, let's look at the current price here first, though, for Synopsys. $495.50, the 52-week range, $365.74 is the low, and the high, $651.73. Now, we'll look at those earnings going forward, and, this stock appeared to be pricey. You look at October 2026 estimated earnings per share here, $14.20. Gives you a target sell price still of $235.72. It's trading at nearly 34 times those future earnings.
Yeah, and that's pretty amazing because when I looked at the $14.20, what I got concerned about was the range of the estimates are low at $12.72, a high at $17.18. We like those tighter. And then actually over the last 90 days, I saw that range is down 16%. It was 16.91 90 days ago. So this company is
I mean,
not going the right direction.
Maybe they gave bad guidance too, because that could be concerning as well. If they did give bad guidance, maybe more analysts are still going to be coming in, and those earnings estimates could continue to fall and pressure, again, a higher forward P and a lower target sell price. You don't want things going in that direction.
No. This is why we kind of warn people about paying too much for companies, because they can drop dramatically. And kind of disappointed. We thought maybe we'd find a good buy here. Actually, this whole show, we not found a buy at all for people this time.
Yeah, I mean, the tech space, you maybe think you can find some stuff when things are falling, but I think things just got so expensive that things falling 20% still doesn't warrant a value.
Well, that's where patience and investing comes in. It's so hard because you want to be doing great all the time, and sometimes really patient. Well, there's a closing bell. Thank you for listening to the Smart Investing Show. It is for information purposes only and should not be used as investment advice. Let's discuss in more detail your investment needs, have other investment questions. Feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Free newsletter there, great information. Again, smartinvesting2000.com. Thanks for listening. Back next week right here on the Smart Investing Show.